We'd like to thank everybody for joining us today. This is our Q4 quarterly review and market outlook, I guess. We got to come up with a better name than that, something a little more snappier, but that's what it is. We'd like to thank our sponsor this time. This is sponsored by coronavirus, since Mark and I have both had it. We'd like to thank the sponsor, and they would like to remind everybody to keep washing your hands, wearing your masks, and doing the right thing. Again, thanks everybody for joining us. These things are kind of fun for us. I think they are fun for us, actually, but they do take a lot of work, and we hope that they're very informative for you. So thanks again for joining us. I think I want to start with just a recap of the year of 2021, and I would point out Mark did a great recap of what happened in 2021 in our dictation that went out with our client reports here in January. So I'm going to refer to that quite a bit. But as I was preparing for this, I kind of forgot of all the things that happened in 2021. For instance, remember GameStop? That was January 2021, that big run up right there. Obviously we had the storming of the Capitol. There was an impeachment. Remember the Olympics? The Olympics were last year as well. The vaccines rolled out last year, and mandates, all that stuff. Delta, Omicron, that's the first time we ever heard of those things. So it was a big year. And also just wanted to note that, US topped 800 deaths due to COVID last year as well. So it was a very busy year last year, regardless of what the markets did. But anyways, so the kind of recapping the investment market last year, Mark summed it up very nicely in his report to clients that it was kind of a mixed bag. Stock markets were up really well. The large broad indices were up really big, almost all the way around. No matter how you kind of segmented the market, some were up more than others. Foreign markets were up. Even emerging markets, certain segments of it were up as well. If you peel open the onion a bit, you kind of see where certain segments did very well. Other markets did really well, and some markets did okay. But stocks did really well last year. Alternative investments were pretty good. They were up positive, and bonds were kind of a stinker. Either they're down, or if you're lucky, maybe they were just kind of flat. But overall, broadly though, bonds were down. So it was kind of a mixed bag last year. Also remember last year we had a continuation and maybe a bit of a ramp up of the stimulus that had been going on started in 2020 from the Fed, where easy money programs were instituted just to kind of keep liquidity in the market. The Fed, also the US government kind of chipped in as well, continuing with stimulus and getting rebates and refunds, continued benefits for those who are unemployed. Those things seem to continue. So there seemed to be a lot of cash in the system, and that kind of seemed to stimulate quite a bit of buying from the consumer point of view. And we kind of ended up, the big thing that kind of ended up end of the year, I guess, two big things. One big thing was inflation. Inflation was up 7% last year, which we haven't seen in 20-30 years. I mean, long time we haven't seen this kind of inflation. And then it also kind of led to, with the volatility at the end of the year as well, that kind of continued into January here. It also kind of leads to the question about the stock markets of, are they overvalued? Do we have bubbles that we should be worried about? Like, is there a stock market bubble? Is there a real estate bubble? Some might even argue that alternatives might be in a little bit of a bubble since their run up in the last couple of years. And oddly enough, even though bonds seem to perform kind of badly, there is some concern that bonds are also in a bubble. So we're kind of faced with this kind of not even a trifecta, it's a quartfecta, I guess, of challenges coming into 2022. And so the question remains, well, how do we deal with all this? Inflation, possible bubbles, where's the market going to go? Is stimulus going to continue? What's the Fed going to do when they raise rates? So how that'll affect markets. So there's lots of little challenges here. So we're going to try and address some of these things in the next 45 minutes to an hour kind of thing, and hopefully answer your questions. And if you do have a question, I'm not sure if it's available to people watching, but there is a Q&A panel in the Zoom that you can pose a question, or maybe even in the chat. We'll try to pick those up as we go, but I make no guarantees because we're juggling a lot of balls here between Mark and I with charts, subject matters, and watching questions come up, but we'll do our best. Okay. So with that, Mark, where do you want to start? You want to start with stocks? We kind of ended the year. Stocks in the broad market were up a lot. If you had index or very broad investments, probably did very, very well. I know our clients did. And we kind of ended the year with a little volatility, and we continue to have volatility through the month of January, even though we had a little bounce here in the last couple of days. So let's start there. What should we expect, or what's the market look like right now? And I think we have some charts and whatnot to look at as far as valuations and that kind of thing, which are kind of interesting.
Yeah. So I thank you for everybody who's on this call. I'm really happy. We have a big turnout, and we apologize about the delay. I'm still coughing a little bit. I'm going to try to hit the mute button as fast as I can. It's much better than it would have been last Thursday, I'll tell you that. But anyway,
I can confirm that, because I talked to Mark last week and it didn't even sound like him.
Walking Dead. Okay, so since our last one of these webinars, I think the questions really haven't changed much, except now we have a volatile stock market. Okay, right. It's been what's the stock market going to do? What about bonds? What about interest rates? What about inflation? What about the debt? So we're going to talk about all of those, or continue talking about those, and then kind of work in some of the additional questions we've had. But what I'm going to start with is let me show you, and I have a lot of charts, and I'm a chart person, and typically I have people here to try and talk me into not doing as many charts, but they're not in my office right now. So unfortunately, you're going to see some. Okay, so let me share my screen here. Hold on.
That's never good to hear.
Yeah, hang on, sorry. The button is covered. Oh, okay, hold on. Yeah, that's not good. Okay, there we go. Okay, so this screen is on my left screen, so I'm going to be looking away a little bit. But okay, so this is kind of what's happened. A chart of what's happened since 1996. Okay, and it's this investing in stocks and the stock market is not a linear path. Okay, but this has been a really interesting path since 1996, and especially since the Great Recession. We had this big drop off, 08, 09, and then this spectacular run where the stock market was up 400%. Mm-hmm. Then we had COVID hit. Okay, so just kind of give you an idea, I'm going to be talking about some valuations too, because that's a question that we have received from clients. They're worried about the stock market being too expensive, and I don't blame them. But as we went in pre-COVID, okay, so this is at the end of actually, I guess this is the end of 2020, excuse me, the price earnings ratio, which typically averages about 15%. Yeah. We went into the year averaging 19.2 on that price earnings ratio. I guess this is COVID. I'm sorry, this is pre-COVID. Then we dropped all the way down to the low of COVID, minus 34%. And we got all the way down to a price earnings ratio of 13.3, which was below the average. And then we had this huge run up again that we've experienced since the March lows into last year. And now currently where we stand is 21.2 on the forward earnings. Okay. But what's interesting, and I'm not going to show you this stat, you'll just have to take my word for it. The earnings on the S&P 500 was about $150 per, for the S&P 500. They're expecting it to be $150 before COVID. And now they're expecting it to be $230 this year. So it's like a 50% increase from pre-COVID. And so it just shows you if that materializes, what the effect of all this government stimulus has done. The $4 trillion of COVID relief, low interest rates, and all the all the stimulus. Mm-hmm. But as we look out, a couple. This is kind of the PE ratio, just to give you an idea. So we're at 21.2 right now. If we took the most expensive stock market of all time by PE ratio, I believe that's the case, right, of the .com era, the PE ratio is 25.2. And again, we got all the way down to 15, and then we're currently at 21.2. Now, just a kind of if you kind of a learning lesson, if you know this, excuse me, but there's two ways, earnings cause the growth in the stock market. Okay, earnings growth. But there, and what we did have last year in 2021 was earnings were up 50%, 50% from the previous year. Now, granted, that was a COVID low, right? So the stock market going up, the S&P 500 going up 28% last year was warranted because earnings went up 50%. Okay. But the question now on a go forward basis is, can we continue that momentum? Now, there's no way we're gonna increase by 50%. The current estimates are for earnings to go up 9%. But the real question out there, and the reason the stock market is being testy, to say the least, right now, is because now the Fed is wanting to raise rates, and they're expecting 4 to 5 quarter point interest rate increases by the Fed right now this year. And the whole reason for the stock market booming in the last 5 years was don't fight the Fed, all the stimulus, but now that stimulus is being taken away. And so I'll go into some charts in just a little bit to kind of show that there's a conundrum, because everybody's worried about inflation, but the bond market is kind of signaling that they're worried about growth in the future. So I'll cover that in just a second. So
that's a good chart there that I'm impressed by. When I'm looking at it, my eye goes to how steep and how fast that rise in the S&P 500 has happened in the last 2 years, and that is all stimulus primarily driven.
Yeah, stimulus and which did turn into earnings. Now, one side note that most people I'm sure don't know is that since 2000, so since the .com bubble, the S&P 500 has only averaged 7.5% per year over that whole time period, over 20 years. And that's, we forget that there were two huge drops in the stock market, two real gnarly bear markets, and actually a third one with the COVID stuff. So even with this big, huge spike, S&P 500 only averaged 7.5%. Okay, so another thing that's happening, and I'll try and do these quickly. I've written about for the last couple of years is we're seeing a big concentration in the S&P 500 and other indexes. And as you can see right here, 30.5% of the value of the S&P 500 is from the top 10 stocks. So the 490 other stocks comprise 70% of the remaining 70%. So that is, as you can see, is historic, right? So the next highest point right here was in 2000, which was like 26%. So, and that is primarily because the top companies in the S&P 500, the Teslas, the Apples, the Amazons, and all these companies, they've done a really good job. They're killing it. They're making tons of money, and they have earned the right to have their current values. However, there is a point where stocks can get really expensive. And so that's just something that we need to be careful of. So those top 10.
I'm sorry, Mark. I just want to say for everybody, you might see economists or articles about this referring to the mega cap 8 or the mega cap 10. That's these companies that Mark's talking about that are comprising so much of these indices. It's very concentrated.
So and so you might think that you're having diversification from 500 companies when that's not necessarily the case. Now, going back to that price earnings ratio, so the top 10, the PE ratio is 33%, and typically the average of the top 10 is just under 20. So it's at 168% of its long-term average, and then you can see the remaining 490 stocks is only 126% of the average. So it's just top heavy. Okay, so
right.
That's the message. Now this is a chart that is going to get needs some explanations. I'll try and keep it simple. So for those of you who have seen Morningstar charts, this chart right here, there's these 9 boxes, and they're basically segmented by small companies to large companies on this axis, and then value and growth on this axis. And again, this isn't going to be a surprise, but what we've seen, this number at the bottom is the long-term average. So this would be large cap growth. This would be large cap value, small cap value, small cap growth. And again, what you can see is large cap growth is, I didn't do the percentage math, but you can see is so far above the long-term average that it's just something to pay attention to. Because again, stocks don't go linear forever. They can go linear for a long time, and they have, because large cap growth companies have gone up for 10 plus years. But what we'll show you in a little bit is we think these value companies, which are much more fairly valued compared to historic purposes, you could see a rotation out of some of these things, the growthy stuff, into the value-y stuff. And we've seen it over the last couple of years.
Right.
And then
this also highlights the importance of allocating across the segments of the market the best you can, not just concentrate on what's been performing the best the last couple 3 years, because you're going to get you're going to wind up losing more than you should at some point when those things start to correct.
Exactly. So, okay. I'm going to skip that one. I'm going to skip that one because that's really confusing. Okay, so I'm going to stop my share here now. Dan, what do you, let's see what here.
So about the markets, kind of a couple of questions I've received from clients was, since you're not really getting anything from your bonds, you're not getting paid much of anything from interest, it's just kind of sitting there. I've had a couple of questions which basically they come in different forms, but it kind of boils down to, should I take more risk? And after what Mark's shown us, the market's looking pretty frothy, pretty overvalued in lots of the segments of the market. So to take more risk to kind of get a little more return, probably not the right time now. So I think probably from our standpoint, what we might be thinking about is not letting the stocks get too far away from us, maybe pulling those back in client portfolios to be more in line with target. That's probably going to be things that are going to be on our mind going forward here as things kind of play out throughout the year. So that's kind of our stance. So taking more risk to kind of get more return. It's not the right time. It's not the right move. And that's not something we would normally advocate just to kind of, in order to kind of juice returns. That's not the kind of investing we do. We just want to make sure our clients have a steady experience to where they're going to avoid making big mistakes, because big mistakes are just way too costly to recover from, especially if you're retired and in a drawdown mode where you're relying on your assets for income kind of thing. So we want to be a little more restrained, a little more cautious with our risk taking at this time, I think. Would you agree?
But also, Dan, the conundrum that I'm sure everybody's feeling is the Federal Reserve with its policies and the government with their fiscal policies, have created bubbles all over the place. So you could make the case that there's a stock bubble, okay? But I've also we've written and talked about over the last couple of years that yes, the bubble is there in stocks if you compare it to past history, but stocks are still, if you compare it to bonds or other types of investments, they're still relatively attractive, okay? But you also have a potential bond bubble with the lowest interest rates in history. And we've seen, minimal losses in the bonds recently. Real estate bubbles, potentially. You could, there's other types of bubbles that you could make a case of, was there a crypto bubble or whatever? But the issue is, where do you invest? And so, as Dan said, yeah, I would love to pull back the risk on stocks, but what do you go from 60% stocks to 30% stocks and then buy bonds with the rest? It's a very challenging environment. So, and we did make some moves in the portfolio to kind of reduce our exposure to bonds and buy some other things that we thought would go up that actually turned out okay. I'm going to go back to just a few other charts just to kind of show. So other questions, from clients is the volatility. The S&P went down 10%. The NASDAQ went down 15+% before recovering.
Right.
If I had to place a wager, and I know that's not a good way to betting on investments, but I would say that there's probably a higher likelihood that we're going to see more volatility in the future. And really the only reason is because we have high valuations in stocks, and we have a Federal Reserve that is trying to raise interest rates into an economy that is already slowing. And the economy didn't really slow in January, but a lot of the growth in that was from companies building their inventories. And so that will have a snapback. So with regards to volatility, it's also, I like this chart. You may have seen me shown this at some point, but this is a chart that shows annual returns since 1980 of the S&P 500. And one thing we just need to just always keep in mind, that volatility is the price of admission when it comes to stocks. And what was not normal was the lack of volatility that we've had in the last year up until the recent volatility. So for example, the S&P 500 was up 27% last year, but the market never went down more than 5% throughout the year. And we've had some clients, some clients say, well, you haven't been doing that much trading, but we only do trading when there's volatility. And so sometimes we do thousands of trades and sometimes we do no trades. Right. And that's a result of volatility. And then you look at the COVID year, S&P was up 16, but we were down 34%. But if you look at all these returns, there's two things that strike me on this chart is one.
Mark, you need to share your screen because we don't see the chart.
Oh, you should have told me that a long time ago. Oh, so that's like me talking to myself for the last 2 minutes, right? Okay.
That's right.
Okay.
That's great.
Okay. Here's my favorite chart. Okay. So now you see it.
Yes.
So here's last year, only 5%. We'll call that drawdown. Right. 16, the previous year, 34%. But okay, so a couple of things to note is one, even though stocks average 10% thereabouts, maybe a little more than that over the last 100 years. Right. They're very rarely do they get to 10% or less. Like within 10%, it's up 30. Down 20, up 20, so if you look at the number of up years, and then also you look at the volatility.
There's not 1 year there that says 10%. If you look at that.
Yeah, I have another chart somewhere that shows the 10 within 0 to 10% was like 5% of the years or something like that. But you can see this volatility is all over the place. But typically stocks, don't go down 34%. Or 50% like they did during the Great Recession, right, or the .com. So these are events that don't happen often, but when they do, they're big. But stock market, S&P 500 going down 10%, and the NASDAQ going down 15% is completely normal. The real question is this the beginning of something bigger, right? This is the moral of the story also, but the S&P 500 is, we always have to keep in mind that I hate to say this, we're long-term investors because everybody wants to make money every year. But if you look at every 1 year holding period, you have a 75% chance of the stock market going up, the S&P 500 going up. Over 5 years, it's 88%. Over 10 years, it's 94%. So you really do have to take a long-term perspective on investing, which is still the case. Even with these valuations, we still need to take a long-term perspective. And if we see more volatility, we're going to be in there buying and doing the best we can to reposition the portfolio for better growth in the future. So, any thoughts, Dan?
No, I think that captures kind of the issues with the volatility in the stock market. How do we deal with it? I think that sums up very good. There was one thing that kind of did come up about in our discussion internally, and I don't know if we wanted to hit this on a head right now or not, but we did talk a little bit earlier about the valuations of the market. As we peeled it back, we see there's like value has a little bit better of a value play right now from a pricing standpoint. Are there other parts of the market that are showing some other possibilities that are not so expensive? Maybe they're a little bit more value. And as we kind of peel back the layers of this, we were talking about foreign markets a little bit are showing some areas of the market where there might be some opportunity there. Do you have something to show that, or do we want to talk about that a little bit?
Yeah, sure. So let's go with the growth versus value, and then I'll go in the international just because of the timing. So so as I showed on a previous chart, the outperformance of growth is historic. Okay. And primarily this has happened because of low interest rates. Growth companies do better when interest rates are low, because the value of their future earnings is more valuable when interest rates are low. So this chart right here shows growth is the yellow, and blue or green, whatever that is value. And so the outperformance is, like I said, is historic. And the last time we've seen it like this was, if you look here, was .com. Okay. And I don't know if it's on the next chart, but even .com, that growth versus value got even more out of whack than it did right now. But what happened when the .com bubble burst is, even though growth companies got killed, they went down, like S&P 500 went down like 50%. Value companies were up. So it was a segment of the market. And so so clients might be asking, well, why don't I just buy the S&P 500 because it always goes up? It doesn't. In between 2000 and 2009 or 2010, the S&P 500 was negative, didn't do anything. So this, let's see here. This shows you, again, these are the charts I shouldn't be showing, but again, it just shows growth versus value is very cheap. And again, so here again, if the long-term average of value companies is 14, it's now 15.77% versus growth, which is currently the historic is 20 versus 30. So it's just something to pay attention to. Okay?
Again, just so we kind of bring this back a little bit, going back to something you said a little bit earlier. These things never, we say a long-term average of 14%. These things never go at 14% forever. It's wham, it's wham, da, 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 da. So as we look at this, you say, you could make an argument that the value sector of the stock market could continue to increase, because that's what we typically see. You see big swings to the up, and then it will correct down, and then it'll correct back up. So what we're seeing is, in growth, a big upswing, which now we're kind of up here. Our expectation is, well, that's got to correct and come down, while value still has maybe some more upswing to go before it corrects back down.
So if interest rates continue, so like if the Federal Reserve, backtracks and they don't raise rates and interest rates stay low, growth may continue to do well.
Mhm.
But if that's not the case, I would anticipate a snapback, a reallocation, or back to value where value could outperform.
Right.
Okay, so foreign versus domestic. Some of these things we've been talking about for several years, because value stocks have been cheap for several years and international stocks have been cheap for several years. Okay, so again, the timing we don't know, but I do want to show you, again, this is an intimidating chart, but what I would focus on is here's US stocks, European stocks, Japan, emerging markets, and China. And so this little line right here is the average price earnings ratio. And again, the number doesn't matter. It's just, it's relative. Okay. So in the US, if the average is 16.8 over the last 25 years, we're at 21.2 versus Europe average is 14.8 versus 15.6. Japan is even cheaper than that on a relative basis.
Right.
Emerging markets is close to that line. And even China, believe it or not, is
undervalued,
close to that line. So I took this chart out, but if I showed it to you, it would say that international stocks and emerging market stocks actually have better long-term returns than U.S. stocks. Okay, so these aren't cheap because their returns are terrible. I think there are reasons why these countries are cheap. Maybe they're not growing as fast as the U.S., but again, it's something to keep in mind. Currently, we have about 30% in these non-U.S. stock markets, and these non-U.S. stock markets have underperformed over the last 5 to 10 years. Which you may have heard us say, there's always something you're not going to be happy in our portfolio. Absolutely. Because that's how diversification works. Okay. And a lot of clients were not with us during this time period, but between 2000 and 2002, when the S&P 500 was down 50%, every client was profitable. And it's like, how did that work? Because bonds were up, real estate was up, value stocks were up, small cap stocks were up. Right. That's when diversification works. But the flip side of that coin is it won't work over long periods of time too. And that's when it's easy to say, well, why don't I just buy the S&P 500 or buy this or buy that? So it's a tough task to beat the market all the time. Here's another look at this historic outperformance of US. So if we look at the purple is Europe, international. And again, so during that 2000 period, when the stock market was down 50%, these were up 64% over 7 years. But you can see the outperformance of US stocks is, again, historic. And so when these values get so historic, you just have to pay attention to it, because again, returns are not linear. But again, it's just timing. We just don't know when the snapback or the reversal is going to take place. Granted,
the U.S. run up is long in the tooth, so you expect the international to kind of have its day in the sunshine. But again, like you said, the U.S. market could continue for another 2, 3, maybe 5 years. We just don't know what the timing of that is. But we kind of look at that and say, hey, these things run in cycles. It's all cyclical. It's up and down, it repeats and rhymes all the time. So the expectation would be that international stocks should take a run at some point here, but we just don't know when.
And there is a reason why US has outperformed, because it's outperformed. The economy is outperformed, but at some point things just get pricey. They get expensive.
Mark,
Yep.
do you want to show some more on this, or do we want to move to another?
Probably
topic?
not. I think these charts are probably making people's heads spin. So
Okay.
I'll go ahead and unshare my screen.
Yeah, so let's talk about the other big question on people's mind is inflation. And this was a big question we had last year when we did this presentation. This question continues to be asked by many clients. How long will it last? Will we continue to see it go up? What can I do to, protect myself against inflation, or is there things that we've already done that helps protect me? So, so let's just start with the first question of is how long will it last, or is it here to stay, or is it really transitory? I think even the Fed has come out and said this is not really transitory any longer. It's a little more longer term. However, we don't expect it to last for a really long period of time like we would have seen in 70s, 80s kind of time frame. Is that the message you're hearing, Mark? Is that the same questions you're hearing from clients as well?
Yeah, for sure.
And then, so we're going to continue to see some inflation probably for this year. The Fed's come out and said they're going to increase interest rates. Hopefully, maybe they tamp down. That'll help tamp down the inflation that we've been experiencing. But there's also still these supply chain issues that continue to kind of create problems, increase prices, make things not available. I'm sure everybody has anecdotes of going to the store and there's certain shelves that seem a little more empty than others. Maybe it's the paper aisle. I don't know. Maybe it's some other aisle in the store that seems a little thin. So that could be part of supply chain. It could be. We're seeing a lot of even partial closures of certain restaurants, and that's due to shortage of workers. That kind of thing. So that's an issue as well. So all these kind of little bumps and hiccups kind of add to the fuel of kind of increasing inflation, increasing prices, scarcity of items, that kind of thing. So the Fed's come out and says, hey, we're going to increase interest rates over the course of this next year. How might that affect inflation, and how might that affect our investments and what we're doing against inflation? Does that make sense? I don't know.
Well, let me show a chart real quick. So this is the size of the stimulus, or actually, I need to share my screen. Sorry. Okay.
Oh, this is awesome. Yeah, this is a good one.
Okay, so when you hear that there's money printing going on or quantitative easing, this is a chart of what that means. So basically, the Federal Reserve is so the U.S. government is issuing debt in the form of treasuries and mortgage-backed securities and different type of investment vehicles, and then the Federal Reserve is buying them. Okay, so and it's literally a computer hitting this button and then debit, credit. It's that kind of thing. But you can see from 2000, the stimulus, or I mean the balance sheet of the Federal Reserve. So the investments that U.S. government investments that they owned went from $2.5 trillion right here,
right,
pre-COVID, to where are we right here?
I have it covered.
It's right here. From so they increased the balance sheet by $4.6 trillion, which is outrageous. And so the treasuries is in the blue. Mortgage-backed securities are mortgage bonds that the Fed was buying to keep mortgage rates low.
Right.
And then there's other types of investments that they're buying. And so what happened, this goes back to the inflation thing, this is just my opinion, is the Federal Reserve, with all this stimulus, they kind of have to keep the stimulus party going because the economy isn't strong enough without it. And they really should have been slowing these bond purchases, a year ago when the economy was coming out of COVID and was stronger.
Great.
But the Federal Reserve has a choice, and they have one of two paths, and they can't do both, and they can't straddle both, or they'll have a very hard time. Is they either had to kill inflation, because inflation is sticky, right? It's got them really concerned right now. And so how do they do that? They raise interest rates and slow the economy down. Okay. Or they attack, which basically could potentially deflate a lot of these bubbles that are around. Right. Or they don't attack inflation and then just keep the bubble party going. Keep creating you can't do both. And so what they've done is finally they've said we're gonna attack inflation because it's big enough concern, and that's what they're doing. But what's happening is people are worried that they could potentially, with their interest rate increases into an already slowing economy, could lead us into a recession. And the bond market, I'll show you in just a second, shows the concerns around that. But so that's one thing about inflation. And Dan, I had your chart here. Let me see if I can get back to it. About correlations, if you want to talk about that. Dan.
Yeah, we can talk about that. And hold on, just sorry. Yeah, we can talk about that. So just to kind of reiterate kind of some of the things that you said. So the Fed's kind of got themselves in a bit of painted themselves in the corner where they got two things they're trying to do. They want to increase interest rates to maybe tamp down inflation, but they've been on this tremendous surge of quantitative easing that they've probably been going on too long, that they want to pull back as well. So if they do either of those or both of those too much, that could have a negative effect on the market. We could see some bubbles burst. That'd be the worst case scenario, or we'll see some pullback. So they've got a very delicate situation to go forward. And if we were talking about this the other day, that if inflation continues to kind of surge ahead and be as strong as it is, the last really kind of last time this was an issue was way back in the early 80s, and the solution there was to increase interest rates. And no one wanted to do that, because increasing interest rates just makes things more expensive. Businesses can't borrow as much money to stimulate the economy, and it takes a tremendous and I think I mentioned this to you, Mark. It was that in order to do that. Sorry about that. In order to do that, it takes a tremendous amount of political will to do that, because it means putting people through pain, putting companies through pain. And it could be a little bit questionable as whether this Fed really has that kind of fortitude to go ahead and do that, even though it might be the right thing. I'm not saying it is the right thing to do. I'm not sure about that, but they do have to kind of have a delicate tightrope to watch, or even if they do have a tightrope to walk, not watch, walk. But this is the kind of thing they got to balance. They got to figure out how to increase interest rates and ease the quantitative easing without upsetting the stock market. And if they upset the stock market, the question becomes, will they ease back, begin buying again? Recent history would say they probably would. They might, they don't seem to have quite the fortitude or willpower to kind of struggle through these things and create a lot of pain for people. So let's switch over to bonds a little bit. We'll probably be bouncing a little bit back between inflation and bonds. These things are somewhat tied. Inflation is tied to a lot of things. So one of the other questions that kind of comes up is, since interest rates have been reduced so low, the bonds really don't do anything for us. There's, you're not earning anything on bonds. You're not earning anything in cash. And the question comes up is, why do we even have these in here? So if you want to bring up that chart, that correlation chart, Mark, we'll talk a little bit about that. So bonds, regardless of how they are right now, they do play an important part of the portfolio. And part of it is we include them because they offset the risk of the stock market. Even if they do nothing, they're offsetting the risk. Now understand, the last year or two, this has been a unique kind of situation because of all the stimulus and COVID and everything, that all the money that's being pumped into the economy. So it's its own unique situation. But if you look at the long term here at this chart, you see at the top here, you have US large cap and this EAFE, and we call it EFA. So those are stock markets. So US large cap is US stock market. Cancel. I can't cancel that. You cancel. There you go. There you go. Thank you. So the US large cap is the US stock market. EFA is the foreign stock markets. And if you kind of follow that line over here to the fourth column, I'll call it bonds. See these negative numbers? So these negative numbers correlate to what's called correlation. That is, what happens when the stock market goes up? When the stock market goes up, what do bonds do? So this number would indicate that bonds go down when stock market is up. And it would also indicate that when stock markets go down, that bonds go up. And so this is what we call negative correlation. The negative correlation in our portfolios helps reduce the overall risk of a portfolio. That is, the stocks and bonds and alternatives working together to help kind of reduce the risk, reduce the swings in value that your account might have during a market downturn or something like, or a market turnover. And so we see this negative correlation in both foreign markets and in the US stock market. And this is the reason why we have bonds in the portfolio. Even though they're not doing anything, you're probably losing a little bit of money, probably losing ground from an inflation standpoint, but they do really help us manage the overall risk of clients' portfolios. So that's one of the primary reasons why we have bonds in there. We also like them in there during normal markets because they provide a little interest, they provide a little steady income, but we're not seeing that right now. And that's just right now. That will change because things always change. So one of the things that we also did, because this kind of now brings us into this conversation about what to do with inflation, bonds stink, we're not getting any interest rate, is there other things we can do? So we want to talk a little bit about things that we've done in the portfolios to kind of continue to manage the risk, but maybe provide some other return and other income in a safe way. So about, I would say the first quarter of last year, we peeled a pretty significant chunk away from our bonds. So we reduced the amount of bonds that were in clients' portfolios and put them to
20%.
work. What's that?
20%.
Yeah, 20%. And put them to work in other areas that we felt would provide the continued management of risk, that is maybe some negative correlation to the stock market, but maybe provide some other sources of income, reliable income, and also focus on things that might do well in an inflationary area. So some of the things we added were some preferred stocks, which help with income. We added some inflation protected bonds in the portfolio as well to help stave off inflation. And we added quite a bit to our alternatives as well. We added managed futures. We added I don't recall if we added a little bit more to our real estate, but we were including real estate in everybody's portfolio. So those things tend to do very well in an inflationary period, and they have done very well. And we're also kind of trying to find other things that are not correlated to the stock market. That is, if the stock market goes down, we don't want everything to go down. We'd like to have something maybe go up or even stay flat would be ideal as well. Just to kind of helps reduce volatility overall going forward. So those are the kind of things that we've looked at. Those are the things we've invested in. And as we kind of find things that kind of help us do these things, we'll include those as long as they kind of make sense. And at the very least, have the dual effect of A, helping us manage risk, and either B, adding some stable income or fighting off inflation.
Yeah, and Dan, just to add something, so back to this chart, if we look at correlations, like things that or go the opposite of stocks, which we're looking for red numbers here. There's not many. Bonds, Dan talked about. We did add some currency hedges through a mutual fund,
Right.
and that commodity fund was up 10+% since we bought it.
Yeah.
But if we go to bonds, you look at correlation right here, currency again, commodities, there's just not a whole heck of a lot. And buying private equity through a liquid type investment is challenging. And so I actually did some math with the clients with, say half their money in stocks. The change out of the bonds and into these other investments added a gross 1% return to their return. So it worked last year. But we're going to continue to be looking at adding new things because the bond market is challenged. There's not going to be, historically bonds average 5-6%, and I think in the next 3 to 5 years they may only average like 2 to 3%. One other note, Dan, is I wish I had this in the charts, but I got it too late this morning. Is there was a chart that showed that during the last 4 different periods where the Federal Reserve was raising rates, bonds actually had positive returns in the 4 to 5% range. So it doesn't always correlate to bond prices. And so, just because they're raising rates doesn't mean bonds go down.
We're kind of approaching an hour here, Mark. So I want to address some questions that we had. Actually, we have a couple of questions that have popped up here, and 2 or 3 of them. So I'd like to kind of at least address a few of those in the remaining time we have. And one of the ones I want to address, we had an early question come from a client about concern. Are we concerned about the reserve status of the US dollar? And is there anything we can do to maybe shield ourselves against the U.S. losing its reserve status? The U.S. dollar is very strong. It had a very strong year last year. And yeah, there are some things that you can do to kind of shield yourself. And this chart might even help us even demonstrate that. Gold tends to be a currency, we'll call this not really a currency alternative, but gold can be an example of something you might want to buy to protect, loss in the dollar kind of things. Commodities such as that kind of helps. As far as and then we've had things like that in the portfolio for a very long time. Gold didn't do very well last year. It's probably because of the strong dollar action. But as far as the reserve status for the dollar, I think there's an argument to say that, yeah, the US dollar will lose its reserve status. But I think that's a very long-term problem or issue. As our economy and market continues to mature and get older, other markets become very large and more influential on the grand global scale, like China and India. They have very large populations. They have very large economies. So it could be argued that at some point they'll become the dominant economy around the globe, and maybe their currency then becomes the dominant currency of the time. Again, that's a very long-term thing. We're not going to lose our reserve status in next year, probably, or this year or next year. Don't know when that might happen. I think that's a very long-term issue. It actually kind of creates problems with having such a strong dollar. So things are more expensive, like buying foreign, or makes things more expensive at a certain level here in the U.S. So that was one issue. So just come back to answer his question. What can I do? You can buy gold, you can buy precious metals, that kind of thing, or even buy foreign bonds as well, I guess would be another thing to do. Make sure that they're nominated in foreign markets. But again, this is a very long-term problem. Would you
Yeah,
agree?
I mean, yeah, I do. And when I say long-term problem, I've heard, 10, 20-year problem. And for us to be replaced as a reserve currency you'd have to have a replacement that has efficient markets that have trusted markets. Is the Chinese yuan going to be trusted by the rest of the world, or the India or euro? So you need, we still are the most efficient and most trusted financial markets in the world.
Right.
And I don't see anything changing that anytime soon. But I'll tell you what, Russia and China are vehemently, I mean, they want to change that.
Oh,
That is a huge priority, and it's going to be pressure. One thing on the US dollar, which is really interesting, the US dollar has been very strong, which is kind of ironic because of all the debt we have, because the dollar should be weakening. But the reason in my opinion, is it's not weakening is because if you look at the rest of the world, Europe, China, other places, they have more debt than we do. Their debt problem is bigger than ours.
Right.
And so when you look at a US Treasury that's yielding 1.7, 1.8% today, a 10-year Treasury, that's way attractive compared to their treasuries that you can buy. So I think the US dollar will continue to be fairly strong, but eventually, it could weaken. Just not sure when that's going to happen. Also, another thing, you hear crypto, Bitcoin. Is the whole thing about Bitcoin is to be a hedge against a declining dollar and other declining debased currencies. And that's a whole nother story, which for another webinar, but that's another reason why those things even exist at this point.
Let me try to get some of these other couple questions that have come up. So we talked about foreign markets looking a little bit more valuable than, say, U.S. markets based on valuations. So we had a question about what are our expectations for rebalancing the portfolios for foreign stocks. We noticed this kind of disparity in values quite a while ago. I mean, maybe 2-3 years ago. And at that point, we did kind of increase our exposure to foreign markets. Again, we're way early, or being proven to be way early on this. And so we've already made that move quite a while ago. And so what we continue to do is when we do rebalance is that if we're underweight in those markets, we're going to buy those markets. And that's what we'll continue to do. Keep portfolios on target, at least far as our investments in foreign markets. We haven't discussed any further about increasing more. I guess that could be a conversation we might have. But we've kind of laid the groundwork a while ago, and we just continue to kind of follow that trajectory as well. One last question here from someone else here, and then we'll probably have to wrap things up. Someone says they keep on receiving emails or some kind of advertisement saying the POTUS, the president, or the president's administration is targeting retiring savings to increase government revenue. It goes on to say, I believe these are just promotions for us to buy gold, but he wants to know if there's any credibility to these, and should retirees be concerned about this? Is this a real thing that we should be concerned about? I don't know, Mark, have you had anybody raise this question to you? I think I had it raised to me once before.
Can you repeat that? I'm sorry, I was reading a question.
They're receiving emails or notices in the mail saying, hey, the Biden administration is going to go after your retirement account for revenue in order to increase revenue of the government. You should be really concerned. You need to do XYZ, buy gold to protect yourself, kind of thing. I haven't personally seen any of these things, but I did have a client raise that issue to me before, and it just sounds like an effort for this. It's somebody trying to make you scared to get you to do something, which which is an old tactic, especially in the investment world. We prey on fear and greed. And so that's someone preying on your fear to get you to change something. Does the government want to get revenue from your retirement plans? Heck yes, they do. That's why they changed some of these inheritance rules surrounding IRAs and whatnot, so that they can expedite or the taxes they can collect from those. Anyway,
I think the trend to look for is, yes, they're going to try to raise revenue by doing creative things. But my policy is I don't really spend too much time worrying about it until a bill is circulated, until it looks like it might pass, or it does pass. And so that's just my policy. And because this whole tax Build Back Better tax legislation ended up not passing, even though that was what everybody was talking about for a long time.
Okay, one last thing here, and then we'll wrap it up. Investing in real estate, and this says specific in Los Angeles or maybe just in California in general. Do you think investing in real estate is a way to diversify portfolio and provide a hedge towards inflation? Maybe I'll break this into two parts. Philosophically, yes. Owning real estate helps diversify the portfolio and can also help you against inflation, because especially if it's an income property, because you have two things. Typically in an inflationary period, you can increase rents, and plus in an inflationary period, the value of the land goes up. So you kind of get a little bit of a double whammy on that. Then we try to do that as best we can in the portfolios we have. We use REITs typically in our portfolios. Those, like I said, last year, those did outstanding. As far as buying a property here in California or Southern California from an income standpoint, you can try and do that. I'd be very, very concerned of finding something of value, because real estate market is highly priced. So if you could find something that is, say, a fourplex or an apartment building or a commercial building or something, if you can find something that can pay you a stream of income that's more than 1% or 2%, 3%, you're probably finding a gem. What I'm kind of just what I know, just looking around, that consider giving the prices of real estate, it's not a very good value. You're either going to at best break even, or you're going to fall behind from an income standpoint from the rents producing for the property. So you might have to put some more money into the property until you get cash flow positive on that thing. Some people do that because the value of the land increases so fast. It's a win anyways. So anyways, in that short little time, that's the best answer I can give. So I guess we're going to wrap this up. Thank you everybody for your questions, for attending. If these things are valuable, let us know. Let us know if they're good for you. If they're not good for you, let us know that too. These presentations have tended to be very investment market focused, but if there's other things you'd like us to talk about or comment on, we're happy to do that too, and fit these in on these presentations for you. So let us know what you think. If they're valuable, we'll continue to do them. If you don't like the sound of our voice, we'll find somebody else with a better voice. Maybe we'll do a little Cyrano de Bergerac kind of scenario. But anyways, so please let us know. Send us an email. Can we do a Google review? I don't know. I think we're available to that. Or give us a call, whatever's easiest for you. Again, thank you for joining us. We appreciate you. We appreciate your trust and confidence in us, and we hope that this has been helpful to you. Mark, do you have any closing remarks?
No, I do, but I think we're running along, so I will. I do want to note that for those who are not clients, the commentary that Dan was talking about that goes in our client performance reports was attached. A link was attached to the email sign up, and we'll attach it again on a follow-up email. So you can read more comments. I guess the one thing that I think I read about that, I can't remember, is I wouldn't be so sure that inflation is the long-term problem. It's certainly the short-term, 1-2 year problem, because all the technology that's out there is deflationary. Things get cheaper over time. And so I think there's a debate there that is to be had, that we don't know how it's all going to turn out, but don't get huddled in one camp, if you will, because there's a lot of things that can happen. But again, I do thank everyone too for attending. It's great attendance. We really appreciate it.
Great. Until next time, everybody, stay safe and be good.